Hello, you're watching Smart Money, and today we're catching up with Sean Peche. He's portfolio manager at Ranmore Fund Management, and we're going to be talking markets. So, Sean, what a time to be on the investment scene with a new bit of history being written, week after week, if not day after day, Trump headlining a lot of it. You've been very critical about the impact the Trump presidency is having on US market prospects in particular. How do you see this playing out, given how Trump's gone about his term up to this point and the economic and market impact it's had so far?
Yes. Hi, Alicia, and thanks for the opportunity and lovely to speak to you. I think one of the problems is that markets like certainty because remember, we are trying to forecast what a company can earn in the future because what is a company worth? It's worth the present value of its future cash flows. So to try and get some sort of sense as to what it's worth, you have to estimate future cash flows. When you have huge uncertainty, it makes it harder to do that. And so that is the problem right now. Even with the tariff mayhem, they're on, they're off, there's a pause, there's not, there's retaliation. It makes it tricky. And so not just for us market participants, but also for business people on the ground. There's some talk that companies in the US have stopped ordering because they don't know what it's going to cost. There are companies in Asia who've stopped shipping. You've got containers on the water right now. Are they subject to tariffs? Are they not subject to tariffs? Who's going to carry those costs, etc.? So increased uncertainty makes it difficult for businesses to manage and also for market participants, and that's the problem.
Yeah. Sean, we've had President Trump say that he doesn't want anything to go down, but sometimes you have to take the medicine to fix something and that eventually things will straighten out. What's your response, having heard that to those saying, ride it out?
Yeah, look, that's fine. We got to take the medicine, okay, until you take the first sip of the medicine, you go, oh, I didn't think it was going to taste this bad. And so maybe that's where we've been. And who's going to take the medicine? Is it American investors? Is it global investors? Is it Chinese? Because, China, US exports to the US from China, I think, are 3.5% of GDP. It's only 15% of China's exports. And so they've got another 85% elsewhere in the world. And so you're going to get stoppages. I think you're going to get supply chain stoppages like you had with COVID, where you're assembling a car, but you can't get a key component. So you can't sell a car without a steering wheel. So even if you're a US manufacturer and you're getting these components from elsewhere in the world, it can log jam things. And so that's maybe the medicine. The medicine we're going to see is coming down the pike, as they say. Canadians are not traveling in the US. They're canceling US summer holidays. And so that's going to be tricky for companies like Disney and the hotels. And it's a service economy. So you've got a lot of that going on. With the arrests at the airports, the UK and Germany have issued travel warnings to the citizens to travel. And a lot of Europeans are not going to be traveling to the States. So there is medicine to be had. We probably haven't had it yet. If anything, they've only just, undone the bottle of the medicine. They're pouring it in the spoon. So let's see. But I think one needs to be careful at this time.
Where are you seeing value right now? Whether it be in the States or outside of of that market specifically, internationally, what are some of the markets, Sean, presenting attractive levels for you right now? And talk us through what's actually backing that.
Yeah, so we see value outside the US. And if you look at our fact sheets, you'll see that we have less than 20% in the US and versus a benchmark of over 70. Where we see more value is in Europe, places like European banks, companies like that, some of the consumer staples in Europe, but also Hong Kong. We've got quite meaningful exposure to Hong Kong. There's lots of Chinese companies that are listed in Hong Kong where the founder's still involved, got lots of cash on the balance sheet, and they've been just discarded. Many investors have said China's uninvestable. Well, I don't see why. Places like South Korea is an interesting place that's coming up on our radar screen. It's kind of been ignored. It could potentially be an interesting place to be. I mean, you've got big major companies there like Samsung Electronics and LG and those kind of global players. And Japan has got lots of strong balance sheets, companies with strong balance sheets. and some fantastic R&D. But you've now got the strengthening yen, so you've got currencies moving, etc. But it kind of gives you an idea. I mean, those places sell at a fraction of the price of US companies, you know, and that's the opportunity. If no one's looking, well, great. That's when you can pick up value, and we value investors, so we like to buy companies that at great prices, and they're only at great prices if they're not in the limelight. The companies that we all know that are in the limelight, well, that's not going to be a deal.
Absolutely. Well, of course, South Africa has been in the limelight. It has been amongst the countries experiencing the wrath of the US, and certainly not, having a great impact on our markets or the kind of activity we're seeing on this end. How's that shaping your view on the South African market right now, as far as valuations are concerned, Sean? But when it comes to both opportunity and risk, especially when you are stacking this up against some of that international opportunity you've just talked us through?
Yeah, look, one that I think that's the important thing is, Warren Buffett's got that famous saying, "Be greedy when others are fearful, and fearful when others are greedy." Okay, people have been greedy in the US. Prices have been very high. It was time to be fearful, and he did that with Berkshire Hathaway selling most of their Apple shares and sitting in cash. The converse of that is, okay, you got to be greedy when others are fearful. That's quite difficult. All this sounds wonderful, but when at the moment arrives, it's tricky. Obviously you need to be cautious. Now, the one good bit of news is, first of all, South Africa is not the only cheap market. I mean, I've mentioned some of these other markets, and there's lots of very cheap companies out there where conditions are good and you don't have maybe the same challenges that South Africa has. But what is quite encouraging, I think, for South Africa and emerging markets is I'm on a distribution list for a company which is looking for investment. Okay. And so when they get a bid, there's that one of their clients is looking to invest in an emerging market fund. We all get emailed, or they're looking for a global equity fund. We all get emailed. What's interesting is in recent days, there have been some new requests for proposal for emerging market funds. And so maybe I think that ties in with what I was saying earlier, in that investors, I think what's happened in recent months is investors are now saying the US is not the only place. Let's look elsewhere. Okay. And that is now coming through, and I'm seeing evidence of that in terms of requests for proposals. So that's good for South Africa, because hopefully some of the international investment makes its way to South African stocks.
Absolutely. And that all on a geographic basis, right? You are overall, though, a big proponent of value stocks as opposed to growth stocks. So, why does that kind of investment approach, Sean, work better for you, bearing in mind, the context or the landscape you've just positioned for us?
Yeah. So, I mean, if you think about it, Alicia, we all like a good deal. You want to go on holiday, you look for what deals are available. Okay. You want to buy a garment of clothing, you look for what's on sale. That's why Black Friday is so popular. Now, what's good about value investing is it gives you asymmetry. And let me give you an example. Let's say you wanted to buy a BMW convertible. Okay. Are you going to get a good price if you walk into the BMW showroom at the beginning of summer on a beautiful Saturday when everybody else is there? No, you're not. You're going to be paying the full sticker price. So when do you want to buy a BMW convertible? Probably in winter, close to quarter end. Okay. When it's rainy on a Tuesday night. Okay. No one is wandering around looking for BMW convertibles at that time. And so if you walk in close to month end and it's been a tough month, maybe you'll get the salesperson to give you a discount. All right. So now you buy your BMW at a discount, and you think, well, what's the trick? You got to wait 6 months to summer. Okay. And so if you then drive it and you go, well, hang on, this is a bit noisier than I thought, I want to sell it, because you got in at a low price. When you sell it, you're not going to suffer the same loss as if you bought it in the middle of summer. If you like it, great, you got a great deal. Okay, so you've got the asymmetry where if you get it wrong, you don't lose too much. If you get it right, you got a fantastic deal. And that's what we do. We do that for stocks. So the trick is you got to wait 6 months to summer.
Of
Okay, so
course, we've
that's why we
seen
think
this.
it makes sense.
And of course, we've seen the story of growth stocks unfold through the major tech companies, right? That has been the global focus, largely due to AI hype around that, and where that's taking us. What's your view, Sean, on investing in these companies now in 2025 compared to other sectors where the growth story evident, but on some fronts, the value story being argued for as well?
Well, if you look at the companies in the dot-com bubble, just to use that example, okay, um, when the internet changed the world, who did really well? The guys selling the equipment or the original things, like the Cisco's or Lucent or JD Uniphase. I mean, some of those are no longer in business. Now, I'm not for a second suggesting that's going to happen, but the real beneficiaries were the users of that technology. Okay, Amazon and eBay and all those kind of guys who use the internet. And so if you think about AI, maybe the beneficiaries are going to be the companies that use AI. And I would think of examples there like banks. Banks are using AI to reduce fraud. Okay, so that lowers their costs. Fraud is a big cost for them. It's using AI to for the on you with their apps. You can open a new account. They can offer. They can use AI to offer you loans. They can price the risk better because they see how you spend and how you manage your bank account. And so we think that actually, in many ways, what you want to be doing is using AI, getting those companies that can use AI to cut costs and save money and grow profits. And I wrote a piece about a year ago, I think it was, and did a piece on there that value investing is the best way to play AI, because what can AI do? It can help you cut costs. And so what you want are those businesses with large cost infrastructures. So yeah, that's what we'd say.
Okay, so that's your investment style, right? And it's boding well. What's the one piece of investment advice or, biggest learning that you've gotten over the years that's holding you in good stead in times like these, or, that's had the most significant impact on your professional career?
I think you've got to be careful of falling for investment stories. And because the problem is it's hard to know when you're wrong. And let's use an example of these obesity drugs. So there's really two companies, Eli Lilly and Novo Nordisk, and they sell these obesity drugs. And so the logic is we've got a large population who are obese. We've got only two companies. Great, they can charge whatever they want. We've got a duopoly. These are great stories. Okay, the share prices are down some 50%. And they're down because as soon as you've got a profitable market, they're not going to be the only people in town. Everybody else is looking for their obesity drugs where it's not an injection, or it works for longer, or it has helps you lose more weight faster. So, you've got to be careful about paying too much for the story. And so that's what I would say. And also, don't fall for FOMO, fear of missing out. It's tricky. You go to a dinner party, somebody tells you about this great story. You think, oh, that sounds like an amazing idea. Surely that's going to be logical, and we're going to make money. But if by the time, you know, there's a far better to follow the advice of Warren Buffett. Jeff Bezos once sat and said to Warren Buffett, when you talk about investing, it just makes so much sense. How come the whole world doesn't do what you do? And he said, because no one wants to get rich slowly. And that's the thing. We all want to go after the shiny thing that's going to make us rich tomorrow. Okay. And that's like betting on the rank outside at a horse race. So rather just go for decent companies. Don't pay too much for them. Don't fall for stories, and get rich slowly.
Yeah. On the topic of guardrails, for the industry as a whole, Sean, is this an industry that is sufficiently regulated?
Yeah, I think in many ways it could be more regulated. Okay. It's certainly not under-regulated. And we know it's not under-regulated because you have these scandals. I mean, in South Africa, we had the BHI Trust investment scandal not long ago. Over here in the UK, they've had the Novus Black Fund scandal. Okay. Um, and in the US, you had Madoff. And what were the problems? I think there's a few easy ways to avoid falling into these traps. The first is, if you're taking advice, make sure the advisor is regulated. Then make sure that the fund manager, or the fund that they want to put you in, or the vehicle that they want to put you in, find out who regulates that investment vehicle. And then make sure that the person or team or company who is managing that investment vehicle is also regulated. So you want 3 regulations. It's no good just having an advisor who's regulated who puts you into some whiskey scheme, okay, and then the guys in the whiskey are running amok, or they're putting you into crypto and crypto's unregulated, etc. And if you actually do that, you'll be fine. If you look at Madoff, that vehicle, they didn't have independent administrators. They marked their own homework. With Novus Black, and if it looks too good to be true, it probably is. At Novus Black, I saw their return profile. They were positive every month. Now, we'd all love to invest in products that generate a positive return every single month. In reality, it doesn't happen. And so when you see that, the warning signs the warning sirens should start going off. Just be careful. You handing over your money, make sure that it's not too good to be true, and those 3 things are regulated, and then you should be safer.
Sean, let's leave it there. Thanks so much for having joined us on Smart Money today. Sean Peche is Portfolio Manager at Ranmore Fund Management.